Welcome to the deep dive. We take the information you need to know and really pull out the crucial insights for you.
Exactly. We do the digging so you don't have to.
Right. And today we're focusing on a giant in the financial world, JP Morgan Chase & Co.
Big one.
We're using their 2024 annual report as our guide. And our mission really is to give you a clear picture of how they're doing.
Yeah, looking at the different parts of their business, the key financials, how they think about shareholder value and what they see coming down the pike.
Okay, sounds good. Let's get started then.
So diving into a company like JP Morgan Chase, it really gives you a sense of the sheer scale,
Hmm.
and the complexity of global finance.
Absolutely.
What kind of jumps out first is their talk about long-term commitment. It's not just profits, they say, but also clients, communities, countries they operate in.
Right, that wider impact.
Yeah, and they emphasize things like financial discipline, always investing in innovation, developing their people. That's kind of their foundation.
And it's interesting, they link that back to, everyday people. They've mentioned over 100 million Americans own stocks.
That's right. Teachers, veterans, retirees, the whole cross-section.
It really does underline the real-world impact a company this massive has on people's finances. So, okay, let's break down how they actually run things. Maybe start with Asset and Wealth Management, AWM.
Yeah, AWM. So what's really striking here is how good they are at attracting and keeping client money.
Okay.
They highlight being ranked number 2 in 5-year cumulative net client asset flows. So basically, new money in minus money out over 5 years. And number 1 in active flows.
Active flows,
Yeah.
meaning people are choosing their managed funds.
Exactly. Rather than just passive index funds, it suggests real confidence in their investment calls.
Makes sense.
And they saw positive flows basically everywhere in 2024. All regions, channels, types of investments, just broad appeal.
Wow.
Plus, top rankings in active ETFs, institutional money market funds, and being named the top private bank globally. It really cements their leadership.
And the total assets figure.
Huge growth there. Reached $3.190 trillion in 2024. That's up significantly from around $1.9 trillion back in 2019.
That's a massive jump, more than just markets going up, surely.
Oh, absolutely. It signals a lot of client trust being placed in them.
And it looks like they're also changing how they deliver that service. The report talks about investing in personalized advice, buying companies like 55 Veep and Open Invest. What's that about?
Yeah, well, connecting the dots, it looks like a clear strategy towards more tailored, more sophisticated wealth advice.
Using tech, maybe?
Probably. These acquisitions likely bring in new tech and methods for more individual financial planning.
Yeah.
And then you add their global expansion, new offices, more advisors internationally. It all points to pushing for growth beyond their core markets.
Okay. Let's switch gears then to consumer and community banking, CCB. This is probably the side most of us know, right? Checking accounts, credit cards.
Yeah, exactly. The everyday banking side. So beyond a little reshuffle of wealth clients a while back, there are some interesting things happening.
Like what?
Take Chase Auto. They originated $40 billion in loans in 2024. Now, that's slightly down on 2023, but it's still up, like 19% from 2019. So the underlying trend is strong growth in car financing.
Okay.
And they saw leases bounce back a bit, though maybe not quite back to pre-pandemic levels yet.
And the digital side seems key here, too.
Definitely. They mentioned more people using their Finance and Drive platform for car shopping and financing online. Digital engagement is up.
Right, and that Chase travel brand seems to be really taking off. $11 billion in bookings? That sounds big.
It is, and up 9% from the year before. Plus, getting ranked number 1 by J.D. Power for their wealth management digital experience, it suggests those digital investments are working. Customers are happy.
Good point.
And we shouldn't forget, they also mentioned initiatives to boost economic opportunity, in places like Detroit and also over in the UK. So it's not just about the products.
Showing that community commitment they talked about. Okay, what about the commercial and investment bank, CIB? This is the big corporate stuff, right?
That's the one. Works with larger companies, institutions. It includes banking and payments and markets and security services. And they did really well in investment banking.
How so?
Well, they claimed the top spot for global investment banking revenue wallet. It's like the total fee pool and the biggest slice of that market share in 2024.
Impressive.
Yeah. And number 1 in M&A, number 1 in ECM, that's like IPOs, and number 2 in DCM, which is bonds. So yeah, they're definitely a major player globally.
And it sounds like they're pushing into new areas too. Private credit was mentioned.
Yes, that's a big one. They're dedicating up to $50 billion of their own money plus finding another $15 billion from partners to really lean into private credit.
So lending outside the public markets.
Exactly. It's a growing area. And they also saw nearly 30% client growth in what they call the innovation economy, tech firms, startups, shows they're targeting those high growth sectors.
And still focusing globally.
Oh, absolutely. Covering clients in over 150 countries, investing in international teams. That reach is key for them.
So generally a positive picture across the different business segments. But reports like this always mention risks, right? What were the main headwinds they flagged?
They did. And geopolitical risk was named, right at the top. Number one concern, which, makes sense right now.
Understandable.
Also, the constant threat of cyber attacks, both on them and on critical infrastructure generally. That's a huge focus.
What else?
Things like the potential impacts from war, cyber warfare, energy shocks, other global threats.
Yep.
Also, uncertainty in some industries' outlooks, the risk of allies kind of drifting apart economically.
Fragmentation.
Yeah.
Right.
And the potential issues from the twin deficits in the U.S., fiscal and trade. And finally, they mentioned needing a really strategic approach to compete effectively with countries like China.
Okay, those are definitely significant challenges. So how are they planning to, navigate all this and keep growing?
It seems like a multi-part strategy. They talk about consistently investing in their products and their distribution channels.
Building on what they have.
Exactly. Leveraging existing strengths. Like we discussed, really focusing on wealth management needs, boosting digital stuff across the board.
And making the different parts work together better.
Yeah, strengthening collaboration, like between banking and markets, to offer more joined-up solutions. Plus, the investment in that innovation economy, expanding globally, and that commitment to communities and reducing barriers to opportunity, it all ties together.
Okay, let's pivot to the financials then, the numbers. There's a lot in the report, obviously, but what are the sort of headline figures for 2024?
Right, the key takeaways from the income statement show pretty strong growth. Total net revenue hit $177.6 billion in 2024. That's up quite a bit, from $158.1 billion in 23 and $128.7 billion in 22.
Big jump. What about costs?
Expenses, yeah. Total non-interest expense also went up.
Yeah.
$91.8 billion in 2024 compared to $87.2 billion and $76.1 billion the previous 2 years.
So costs are rising, but revenue's rising faster.
That's the idea. Their pre-provision profit before setting aside money for loan losses that showed a really strong upward trend, $85.8 billion in 2024.
And those provisions for losses?
They increased too.
Yeah.
$10.7 billion set aside, reflecting those economic uncertainties we talked about.
Okay, so the bottom line, net income.
Net income saw a really substantial increase, $58.5 billion for 2024. Compare that to $49.6 billion in 23 and $37.7 billion in 22.
Wow. And per share.
Translates to diluted earnings per share of $19.75 in 2024. That's up nicely from $16.23 and $12.09 in the years before.
So overall, strong profit growth. What were the main things driving that performance?
Well, a few key things. A really big factor was a one-off $7.9 billion gain they had from Visa shares in the second quarter of 2024.
Oh, okay. Bit of a special item.
Definitely helped the numbers.
Yeah.
But also higher fees in asset and wealth management and consumer and community banking played a part. Investment banking fees were up too.
Good underlying performance then.
Yeah, and lower losses on their investment securities also helped.
Mm-hmm.
And you have to remember the First Republic acquisition in 2023 also gave them a boost then from a bargain purchase gain.
Right. And the higher expenses, what drove that?
Mainly higher compensation linked to performance, but also more people employed.
Right.
And there was a $1.0 billion contribution of those Visa shares to their charitable foundation.
Okay.
That was partly offset, though, by lower FDIC costs compared to 2023 when they had that big special assessment fee.
Got it. And the increased loan loss provision just reflects caution.
Yeah, it reflects actual loan losses happening, plus adding more to their reserves just in case. Prudent planning, basically.
Okay, let's glance at the balance sheet. Key numbers, end of 2024 versus end of 2023.
Sure. Total assets grew quite a bit to $4.09 trillion from $3.70
$4 trillion, that's huge.
It is. Investment securities holdings actually went down $89.6 billion from $108.6 billion. Loans outstanding were up $740.9 billion versus $681.7 billion.
And deposit.
Average deposits held pretty steady, $2.59 trillion in 2024 compared to $2.57 trillion in 2023.
Okay. And the value for shareholders.
Equity.
Common stockholders' equity increased to $31 billion from $29 billion at year-end.
All right. And cash flow. How did the cash move around? Well, net cash from their operations was $86.1 billion in 2024, which is actually down from $128.2 billion in 2023.
Interesting. Why the drop?
Lots of moving parts in operating cash flow, but it can fluctuate year to year. They did spend more on capital expenditures, though $11.7 billion compared to $9.2 billion.
Investing back into the business.
Right. They also paid out more in dividends, $11.2 billion versus $10.6 billion, and bought back $13.2 billion of their stock, slightly less than the $14.4 billion the year before.
So returning capital to shareholders.
Exactly. Cash holdings decreased down to $469.3 billion. And cash interest paid out went up quite a bit, $99.6 billion from $77.1 billion.
High rates environment, presumably.
Makes sense. And you can also look at free cash flow from that, right? Operating cash minus the capital spending.
Yep, that gives you a measure of the cash they have left over for other things like dividends, buybacks, or paying down debt.
Okay, so that paints the financial picture. Now, how are they thinking about using their capital specifically to create value for shareholders going forward? They talk about taking a long view, especially with what they see as excess capital, maybe $30 to $60 billion, depending on future rules.
A lot of flexibility there.
Potentially. Their number one priority, they say, is a secure dividend. They're aiming for about 30% to 35% of current earnings.
So reliable income for shareholders first.
That's the message. Then, priority 2 is investing in organic growth, their own business, where they see good returns.
Makes sense. What's next?
Acquisitions are third priority. But they kind of flag that finding really good, large deals is tough right now.
Okay. And buybacks.
Buybacks are actually the last priority. And they have an interesting view. They think buybacks should really benefit the ongoing shareholders, the ones sticking with the company.
How so?
Well, they suggest buybacks become less appealing when the stock price gets too high, specifically above 2 times tangible book value.
Ah, so they don't want to overpay for their own stock.
Seems to be the thinking. And like we saw, they paid out $11.2 billion in dividends and bought back $13.2 billion in stock in 2024. So they're doing both.
Right. A balanced but maybe cautious approach on the buybacks. Okay, finally then. How do they assess the business overall? Looking ahead, what's the tone?
They really stress the need to constantly assess everything. Competition, customers, their own people.
Staying sharp.
Exactly. Needing to move faster, coordinate better in what they see as a faster, more complex world. They use the phrase, analyzing the good, the bad, the ugly in all parts of the business.
So being self-critical.
Seems like it. And focusing on cutting waste, not just costs, while still making investments that drive, healthy growth.
Smart distinction.
Yeah, and they highlight leadership needing to question the status quo, adapt to change. They also mention constantly reviewing programs to make sure they make business sense and line up with goals and changing laws.
So continuous improvement.
That's the theme. They acknowledge the uncertainty in some areas, but they also point to strong growth trajectories elsewhere. And the final message from the chairman and CEO really emphasizes the quality of their people, the respect from clients, and the global demand for what they offer. It's a picture of, I'd say, resilience and cautious optimism.
Okay, so let's try and sum up this deep dive into JPMorgan Chase's 2024. We've seen pretty strong performance across their main businesses.
Yeah, AWM, CCB, CIB, all showing momentum in different ways.
Significant financial growth, though helped by that one-off Visa gain alongside rising expenses and provisions.
Right, strong revenue and net income growth, but managing costs and risks is clearly ongoing.
And a clear strategy for shareholder value dividends first, then organic growth, then maybe acquisitions, and buybacks last, especially if the price is high.
A fairly defined pecking order for capital.
And looking forward, they're very aware of global risks, but seem confident in their ability to adapt, invest strategically, and leverage their strengths.
Yeah, focusing on efficiency, leadership, and meeting client demand globally.
Which brings us to maybe a final thought for you, our listener, to chew on.
Yeah, for a massive global institution like this, how vital is that ability to constantly adapt and innovate, facing all these economic, geopolitical, tech shifts? How vital is that for their long-term survival and ultimately delivering that shareholder value they talk about?
It's a really crucial question in today's world, something to think about. Thanks for joining us for this deep dive.